still MFRS 15. Now we go to example 3, that is contract liability. Okay, so the question says that on 1st March 2017, Harry enters into a contract to transfer a product to Propel Berhad on 31st July 2017. So the first step is it enters into a contract. So there's a contract. And second step, identify the PO. So Harry need to transfer a product to the customer. So there's only one product. So that means there's only one PO. Okay, and this product is to be delivered on 31st July 2017. So product, okay, to be delivered on 31st July 2017. Okay, it is agreed that Propel will pay the full price of 10,000, okay, in advance. The full price of 10,000, this is the third step, that is determine the transaction price. So this is number 1. This is transfer a product is PO, and 10,000 is the step 3, that is the TP. And this amount is to be paid in advance, okay, on 1st April 2017. So the agreement says that the company is entitled to receive payment on 1st April. So right to receive payment is on 1st April 2017. Okay, the contract is non-cancelable. So just to highlight that the contract exists, because if the contract can be cancelled by any parties without compensation, then it is not considered as a contract. Alright, and then Propel, however, does not pay until 15 April 2017. So 15 April is the payment date. Okay, does not pay until 15 April 2017. So the company receive payment from customer on 15 April. According to the agreement, according to the contract, the customer should pay on 1st April, but they only pay on 15 April. Okay, and Harry delivers the product. Okay, deliver. So this is step number 5, where you fulfill the obligation. So this is number 5. This is 3 and 4 lah, because you don't allocate your transaction price to different PO. You only have one PO, so you only have transaction price. Okay, so you deliver product 31st July 2017. Alright, you are required to prepare journal entry. So you see there are 3 dates here. 1st April you are entitled to receive payment. 15 April you actually receive the payment, and on 31st July you deliver the product. So remember that company can only recognize the revenue when the PO is fulfilled, which is on 31st July. So on 1st April, the company is entitled to receive the payment. Therefore, on 1st April, okay, on 1st April here, you should debit account receivable, because the company has the right to receive payment on this date. Okay, right to receive, but the customer has not paid yet. Therefore, on this date, the customer is considered as owing to the business. So you debit account receivable. And why do you credit contract liability? Because you you have the right to receive payment, but you have not delivered the product, so you cannot credit your sales. This is considered as contract liability, right? Whereas you deserve the payment, but you have not fulfilled your obligation, so that is considered as liability. On 15 April, you actually receive the payment, therefore you will debit cash or bank, and therefore you credit account receivable, which means you will close the account receivable. On this date, the customer is no longer owing to you. Alright, and on 31st July, you actually delivered the product, therefore you have fulfilled the PO and you can recognize the revenue on this date. And you debit contract liability means that you will close the contract liability that you have created on 1st April. Alright, so that is basically the journal entry for this example. Alright, now we move on to the next slide, that is contract modification. Okay, probably at the beginning you have discussed and agree to the original contract, but later, at a later date, there are some modification to the contract, and both parties agree on the changes, which is the change can be in terms of the scope of work of the contract, or maybe the changes in terms of price, or maybe in both. So you will treat it as a separate contract if addition of promised goods and services that are distinct, and the price of the new obligation is consistent with the standalone price of the good or service transferred. Separate contract here refers to treat the original contract and the contract that you modify as a separate contract, that is as a two contract, if it fulfills this condition, which is the additional goods are distinct and the price of the new obligation is consistent with the additional product or service that you are providing. Okay, if you look at example in the textbook, right, in page, can you find it? Contract modification, combination of contract. Okay, in page 184 for the old textbook, right, the example says here, in a contract to construct an office building for a customer, a contract modification arises when the customer requests for additional block to be built next to the office building. So the original contract was just to build the office building, but later on you modify the contract that the customer requests another new block. So the price of this new block can be considered separately. So the contract modification is a separate contract because the scope of the contract increased due to the additional good, which is referring to the new block that is distinct, and the price of the contract increases by an amount of consideration. Okay, so if the modification shows that the additional product to be provided is distinct, then you will consider the original contract and the modified contract as a separate contract. Okay, and make sure that you remember this condition, okay, to treat them as a different. So this is a summary. when there is a modification, there are several options that you can do. That is to separate them, the original and the modified contract, as a separate contract when it fulfills this condition, and it is to be treated prospectively. Prospectively, that means the changes are effective for that current year and for the subsequent years. Or another option is to terminate and replace, which means that when you modify the contract, what the company can do is to terminate the original contract and to make the new modified contract as an effective one. Alright, so to replace the new modified contract to the original or to the existing contract. So the condition to use this option is when the remaining goods are distinct and it is not priced at the proper standalone price. Okay, and it is to be treated prospectively. Alright, for example, you have started the contract, you have performed your services since beginning of the year, and only at nearly at the end of the year that you modified the contract. So you have to identify whether the remaining services that you have not yet provided to your customer, whether those are distinct from those services that you have provided before. So if it is distinct, and then it is not, but it's not priced at the proper standalone price, then you should choose an option to terminate the original and to replace it with a new modified contract. Or the third option is to just modify the existing contract when the remaining goods or services are not distinct, which means that any work that you have not performed or you have not delivered to your customer, if it's just similar or not distinct, similar to those services that you have provided to the same customer, then you will consider that just as a modification of the existing contract. So these are the three options, but you have the company need to identify which condition, okay, that allow the company to choose which option. Okay, the combination of contract here refers to if, let's say, you have the company has two contract 1 and contract 2, then this contract most probably can be combined as one contract if it is entered at the same time with the same customer. And these are the criteria that need to be met in order to combine that two separate contract into one, which is it is negotiated as a single commercial package. It is a one contract depends on the other contract, and the services or the goods that we provide to the customer is a single performance obligation. Okay, so then you can recognize it as one contract. Okay, if you look at example in the textbook, okay, under the combination of contract, okay, it says here the contract with different landowners to build their respective bungalow may be combined and accounted for as a single contract. Okay, because landowner are different customer, but you are delivering or you're providing similar obligation, so you may recognize it as a one contract. Okay, similarly, a property developer enter into a contract to sell development unit to different customer, so it will be account for development unit on a project by project basis, but you would consider it as a one project. Okay, also contract in one project are accounted for as one unit of accounting. So even if you you entered the contract with a different customer, but if the pattern of delivering the PO is similar, then you will consider that as one contract. Okay. Now, step 2 is identifying the separate performance obligation. How do you identify? You have learned that in the early example, performance obligation is basically what you as a company need to deliver to the customer. Okay, so performance obligation is a promise to transfer the customer a good or service that is distinct. So what does distinct here means? It means that it is capable of being distinct. The customer can benefit from the good on its own. So if you look at previous example, we have the company need to deliver product A and product B. So in that case, there are two PO because the customer can benefit from product A on its own, and when the customer receives product B, then the customer can benefit from the product B on its own. Okay, so therefore, when product A and product B give a different benefit to the customer, therefore they are treated as a different PO. Or it is considered as distinct if the good or service separately identifiable from other promises in the contract. So this is condition or the criteria that says the PO are distinct. Alright. It is important for you to identify whether the obligation, whether there are one, two, or three PO, because in step 4 you need to allocate the transaction price to each PO if there are more than one. Okay, so how to assess whether the goods or service are separately identifiable? It is actually when they transfer each good or service individually, or maybe when you transfer a combined item or output. Okay. Alright, so this is example 4, single performance obligation. Softec Berhad licensed customer relationship software to Lopez Company in addition to providing the software itself. Softec promised to provide consulting services, okay, by extensively customizing the software. So to provide consulting services is the PO. So this is the step number 2. This is the PO. And that's the only one obligation. Okay, so there's only one PO and at the total consideration of 600,000. So this is the TP lah. Okay, that is step number 3. So identify the performance obligation in the above revenue arrangement. So in this case, SOF is providing a significant service by integrating the good and service, license and the consent into one combined item. Okay, they provide software. Alright, provide software and consulting services, but because this is interrelated, okay, because you need to teach the customer on how to customize the software, so it is considered as interrelated and you will consider it as a one combined item, that is one contract. Okay, so the software is significantly customized by Softec in accordance with specification negotiated by Lopez. So the license and the consent are distinct but interdependent and therefore should be accounted for as one performance obligation. Alright, the keyword here, it is interdependent. Even though they are distinct, but if you don't provide the consulting services, the customer unable to benefit from the software. right? Therefore, you will consider that as one performance obligation. And then next is example 5, Chen Computer Berhad. Okay, this Chen manufacture and sells computer. Okay, sells computer that include a warranty to make good on any defect in its computers for 120 days. In addition, it sells separately. So this is separately. Okay, separately and extended warranty, which provide protection from defects for 3 years beyond the 120 days. So identify the performance obligation. So selling computer with warranty will be considered as one PO, and the extended warranty will be considered as the second PO. So the sale of the computer and related assurance warranty are one PO, as they are, okay, again the keyword here is they are interdependent, and however the extended warranty is separately sold and not interdependent. So when there are two PO, you need to go to step 4, that is allocate the transaction price to each PO. Okay, now this is we will continue this in the next session. Thank you.